Getting straight into it, we earn revenue primarily by completing payment transactions for our customers. It looks like a 90-10 split, with 90% coming from transaction revenues. But taking a look at this asterisk number 2, luckily the financial office immediately answers our question from the beginning. It is $1.8 billion in the last year that is revenue related to interest and fees earned on loans. So let's press forward. We saw that there was $4 billion in additional revenue and $4 billion in additional transaction costs. Thanks to this asterisk, we now know that $1.375 billion of that new revenue was not related to transactions at all, taken by subtracting this number from 2 years ago with the number from the latest year. Back in the income statement, let's now calculate the exact change in net revenue from 2 years ago to now. That would be about $4.4 billion minus the $1.375. Transaction revenue actually increased by $3 billion in the last 2 years, whereas transaction expenses increased by $4. Therefore, we're actually looking at a decreasing operating margin for the transaction business, even though that transaction business is easily more than 90% of everything this company does. That is a very different picture than what this increase in net income on the financial statement tells us. You can imagine I'm quite disappointed to see that the management's office is not making this a clear distinction in their own section, actually including a table suggesting that the operating margin is exactly the same as 2 years ago. Given the deeper statistics that we've already calculated ourselves, this now seems like a suspicious management not wanting to say that the operating margin decreased, but also not wanting to be so bold as to claim that it increased. However, management doesn't completely ignore the situation either. Sure, active accounts literally decreased from last year, but it wasn't that much of a decrease. The number of payment transactions did increase, and the total payment value of the transactions did increase. And so while PayPal perhaps should be happy that they've transacted over 1.5 trillion in a year for the first time ever, what they're not telling us is that they had to decrease prices in order to see these bar graphs go up. And even the decreased prices was not enough to stop active accounts from falling. This slightly over 5% of non-transaction revenue is not a one-time thing, because what PayPal is calling at the high-level financial statements loans are not actually loans that PayPal is taking out. It is a second product line meant to represent when PayPal customers overdraft their PayPal accounts. In the event that the overall return on the PayPal branded credit programs do not meet the minimum return threshold, PayPal themselves would be required to make a payment to their credit partners, the people who collect these outstanding loans from customers. So while I'm sure they're putting a modern spin on it, PayPal is entering the loan shark business. This idea probably goes a long way towards explaining why the management at the beginning of their section was pretty hesitant to highlight the decreasing operating margin of the transaction business. The less efficient the core transaction business becomes, then the more accounts end up actually getting put into this loan shark side. And this loan shark business is fundamentally lumpier and more volatile in terms of the profit that can be expected, turning happy, consistent profit and revenue from healthy customer accounts into higher stakes, difficult to predict overdrafted accounts. Here is the earnings per share for the last 3 years. And so it seems like PayPal has a bit of a branding problem. Really, it's the subsidiaries of PayPal, the latest one of which I think is called Braintree, struggling to keep high quality customers on their books. As these higher quality customers leave, more and more of the remaining transactions do end up overdrafting customer accounts. And while PayPal trying to stay out of that less appealing side of the business, not even breaking it up in the main financial statements into different types of revenue yet, it has already become more than 5% of the revenue in the latest year. Is almost actually the entire reason why this earnings per share is higher than the last 2 years. While this is not a one-time thing and will continue to probably grow from what the trends are looking like, revenue coming from the loan shark side does virtually guarantee larger swings in earnings per share in the future. If PayPal isn't careful, they might lose their blue chip status and become more of a cyclical stock. I'm now going to guess what the SafeSeeds AI is going to rank this, remembering that a ranking closer to the first percentile is the best. As an investor, I'm feeling kind of overall positive about this. While it always would be nicer to stay in the high quality business, and I'm definitely going to keep an eye on management after their half-hearted attempt to disguise the transformation going on. It's a worse business, but someone has to do it in the internet era. Might as well be PayPal. And so I'm guessing this is going to be between the 40th and 50th percentile. But what do you think? PayPal is ranked in the 25th percentile for the 2023 season, significantly higher than what my gut was telling me. Someone has to help the medium and low